Good morning. It's Tuesday, the 11th of March, and this is Govindraj Ethiraj, headquartered in broadcasting and streaming as always from Mumbai, India's financial capital, our top stories and themes. And before we start, this is a holiday-shortened week, so we have a long weekend coming up. So we will be saying bye to you a little earlier this week. Our top stories. The US is headed into recession and India into recovery. Why India stands to pull in more foreign portfolio investor flows in coming months. Inflation could go below 4%. Don't ask for tax cuts. We will bring down your logistics costs, says India's transport minister. A new pharmaceutical research and manufacturing sector is opening up in India and can grow if we get a few things right.
This is a call report with Govindraj Ethiraj.
Time to decouple again. The United States is headed into recession and India into some form of recovery. Now, the second part, that's India, might be a little open-ended and a tad early to proclaim, but the first part has been pretty much promised by US President Donald Trump. He refused to rule out the fact that the US economy would enter a recession this year, telling an administration-friendly news channel that there will be a period of transition for what we're doing is very big. The reasoning apparently is, from what I've picked up from elsewhere, is that there are things other than prices that matter, like family values and cultural issues, which matter to Trump's base more specifically, and the stock market movements, including in the short term, are less important in that context. So that's the view right now. Meanwhile, Wall Street is further reacting, having, of course, given up all the gains it saw since November 2024, when the elections that brought in Donald Trump took place. Remember, Wall Street had also gone up in anticipation of a Trump victory, which they felt would be good for Wall Street rather than, as such, Main Street. Trump, in his second administration, clearly is more focused on Main Street, at least right now. So that's that. And it would be interesting to see how this plays out with all his tech bro friends who are seeing their wealth diminish by the day. On Wall Street again, stock futures dropped on Monday as selling pressures continued. Futures tied to the Dow Jones Industrial Average fell about 427 points or 1%. S&P 500 futures were also down similarly, as were Nasdaq 100 futures, pointed out the CNBC. Tesla's stock, by the way, had never seen such a stretch of red. For 7 straight weeks since Elon Musk went to Washington to join the Trump administration, shares in the automaker have declined and closed Friday at around $270, according to CNBC, which added that this is the longest such losing streak for Tesla in its 15 years as a public company. Last week, the S&P 500 lost about 3.1%, its worst weekly mark since September. Dow lost 2.4% and the Nasdaq Composite 3.5%. All of this from CNBC. September 24 is also the time and the point at which the Indian markets had hit a peak and then took that about turn. Analysts are now telling CNBC that the risks of a bear case have risen, and some are looking at a 14 to 20% drawdown, which of course brings it closer to the Wall Street. So what does this mean for global flows? Well, we have some good answers on that coming up. Back home, the BSE Sensex swung up and down and then closed down 217 points at 74,115. It started in the positive though, usually a sign that some larger investors wait for the markets to open up and then start selling. The Nifty 50 was down 92 points at 22,460. The broader markets were hit too, with the BSE Mid-Cap Index going down about 1.5% and the small cap about 2%. Foreign institutional investors have been selling consistently into 2025 and into March as well. But how can we put those flows in perspective, and what do they mean in the overall context and of the flows that we've seen over the decades? And what can we compute from the allocations that India gets from what kind of investors within those allocations, and what could they go to in coming months? Also in the context of flows towards China and other markets that we've been seeing. I reached out to the London-based Arvind Chari, Chief Investment Officer at Q India UK, affiliate of Quantum Advisors India, and I began by asking him how he was seeing the current trend of FII selling into the coming months.
Just to give you a perspective to your listeners, if I look at over the last 20 years, if I look at foreign portfolio investments into public equities, in the last 20 years, we've seen about at cost as of end December, and I'll give you recent numbers as well. As of end December, at cost, the investments done by foreign investors in equities was about $200 billion, which in market value terms had increased to about $850 billion. So that's the perspective, 20-year data. 200 billion at cost, 850 billion around at market value terms. Of course, we've seen some outflows. So since September, I think we've seen about $25 billion of outflows. In the 2 months of 2025, Jan and Feb, we've already seen about $13 or $14 billion of outflows. So the at cost number from 200 has kind of reduced to about just below 190. And the market value has come down from 850 to about $720 billion. This is just to give a perspective of where we are, what we do. So, of course, markets have corrected. Some of the market value loss is because markets are down between 12 and 14, 15% in dollar terms on a gross adjusted basis. Some foreigners would have been invested in mid cap, small cap, so their allocation would have dropped a lot more. Some would have been very specifically focused on the large investments, so their drop would have been lesser. But net, that's what we've seen. In general, of that 720 billion, which is right now, and 850 billion by December, if you see, I would say about 200, maximum $200 billion of that amount is dedicated India allocation. When I say dedicated, it is dedicated through ETFs, money investments coming through ETFs. It is dedicated through active funds, and it is allocations made by very large investors like pension funds, sovereign wealth funds, university endowments. Their direct allocations to India. The rest amount is what we call global flows. So global funds, global emerging market funds and their India allocations, or these same large investors, pension funds, endowments, university endowments, sovereign wealth funds, their allocation to India through a emerging market allocation. So that's the way to think about it. So of the total market value, roughly about a quarter is coming from dedicated flows to India, and the rest is non-dedicated. Now that is important to note because, if it is non-dedicated, then it is driven by their overall portfolio within the emerging markets and their allocation and what is expensive, what is not, what has done well, what has not done well. So they want to reduce some allocation to India, increase some allocation to China. We have seen some of that. In the dedicated flows as well, India did see a lot more passive flows as compared to active flows in a dedicated flow as well. And we've seen some of those going up. So it could be again be a function of India doing better and people taking money off, or just the worry that growth is slowing down, valuations are expensive, market is correcting, momentum is slowing down, and they're taking money off. And that you will see more of that in passive flows, which is coming into equity. If you look at in the active space, also there was one category of investors which had a lot of India dedicated flows was Japan. India did see reasonably large amount of flows in the last 2 years from Japanese investors into India dedicated ETFs and India dedicated funds. And we may be seeing some outflows because the yen has appreciated a lot more against the dollar and against the Indian rupee as well. So you may be seeing some outflow. So this is just the color of, where we are, what we are seeing.
Right. So the question then is, this is how it's been so far. And from what I gather from what you're saying, the 25% is something that we should assume as somewhat given because these are people who researched India, understand India, have a long connection with it. My question really is, how are things looking forward from here as we are in the middle of everything else in March 2025?
Now, as I've said to you before, and I've written about this as well, if I look at the global pool of money invested in India, it is less than 1% of what is total available. So again, I'll give you some numbers. $300 trillion is what I believe is global assets under management of, again, pension funds, sovereign wealth funds, central banks, endowments, very rich individuals which are invested in asset management companies. And if I total that all up, insurance companies, it's about 300 trillion. And if you look at that $850 billion of market value, that is less than a third of the allocation. Even if you assume that the entire 300 trillion is not subject to global investing and only a third of that will be available for investing in other countries apart from the home country, we are still less than 1%, right, in public equities. Whereas if you look at our share of global GDP, global market cap is already close to 3.5%, 4%. From that perspective, I think as the markets correct, and the correction was due and it is warranted, you would see some of these investors who have thought about doing India dedicated because a dedication to emerging markets or a allocation to China has not worked for them over a long period of time, whereas Indian public equities has been a stellar performing and it remains the best asset class to own globally in public equities. A lot of these investors will start looking at it and say that markets have corrected, valuations are attractive, and we won't have our reasonably sized allocation, and should we make that allocation? And another thing that is driving that is India's weight now in the what we call the MSCI All Country World Index is closer to 2%, just above that. That's a time when we saw investors looking at China and they started looking at dedicated allocation to China a decade back. Maybe we are seeing something very similar with India as well, as India's weight in the global index becomes larger.
This weight, Arvind, was higher 6 months ago.
Of course, it was about 2.4-ish%. Should be closer to 2, just about 2.
If you're saying that, let's say, money is going to come here because we all have traditionally enjoyed a low share of overall pie, would the issue of valuations matter or not matter so much? Because, I mean, that seems to be the one key reason why a lot of investors have been selling off late. And even at this point of time, India is more expensive than China, which people are thinking is more attractive right now.
Govind, there are 2-3 ways to look at that. The fact that valuations are expensive is also a function of growth. So the expected growth that people anticipated to come in different sectors has not come through, and it has not come through for the last decade. India has not grown beyond that 6.5% average GDP growth, much as you talk about different policies, reforms, governance, Modi. It has not picked up, right? So the expectation, maybe people expected a lot more growth to come and bidded up share valuations. Of course, flows in the market also picked up a lot, both domestic, purely driven by domestic. And that growth has not come about, and you can see a correction, which is why I said the correction was needed, was expected, and is warranted, because the earnings are slowing down and expectations are catching up with reality. So that's one way of thinking about, valuation. Other is India should be thought about in a strategic sense. Like, if global investors want to make a long-term strategic allocation, that is what India should be in their portfolio. So from that perspective, of course, valuations matter as an entry point. But when these large investors, say the pensions or sovereign wealth funds, when they take a call on India investing, it should be a 5, 10, 15, 20-year time horizon, right? So entry points do matter. And so, they will start kicking in when valuations are relatively inexpensive. But they have to think about a strategic allocation. India is not a trade. China can be a trade, a tactical trade, a tactical allocation, whereas India should not be. India is a strategic allocation. So they need to think long-term from that perspective. So that's another way to think about it. The other problem could also be capital gains, right? India is amongst the only country which imposes capital gains on foreign investors. So India is not easy to access, and there are transaction costs, plus there are capital gains. So in the eventual framework that they decide, saying that I like India, I want to be dedicated, but what is my net post-tax return? I mean, is it worthy enough for my teams and my research teams and my portfolio managers to spend time on India? There are multiple things that go through it. So, under allocation, but there are aspects to think about it. But we think the way from when I discuss with on my global investors, that we see interest in India rising from these allocators who have not been allocated to India on a dedicated basis.
Right. So last question to supplement to that as well is that, so you're saying at this point where we are again today, interest returning in terms of fresh allocations or fresh flows in the next few months?
I would think so. So 6 months back, we were ourselves guiding clients who were willing to allocate or new investor, saying that if you have $1 to invest, give me a third or a fourth or a half of that, because we don't see valuations as attractive. And the way we manage our strategy, we were basically trimming out and kind of holding cash because we didn't find value. And as the markets have corrected, we've actually changed our guidance to tell clients that they should initiate allocation, and the allocations can increase over time. So you should see some more dedicated flows. But, if you look at the valuation itself, it is, despite the fall that you see, and more than 70% of the stocks have corrected about 30% in dollar terms as well. Despite that, the valuation across board is not attractive. It still seems that the markets are expensive, which again tells me that earnings have to catch up and have to rebound. It will be a bit more calibrated, but we should expect some dedicated flows to come through.
Arvind, it was a pleasure speaking to you. Thank you so much for joining me.
Thanks, Govind. As always, thank you.
Consumer inflation numbers could fall. India's February consumer price inflation numbers may have fallen below 4% for the first time in 6 months on moderating food price rises, according to a poll by Reuters. The poll of 45 economists taken between March 4th and 10th predicted inflation as measured by the annual change in the consumer price index falling to about 3.98% in February from 4.3% in January. The report said that as fresh winter produce hits markets over the past few months, food items, which make up nearly half of the inflation basket, saw a sustained slowdown in price increases. Meanwhile, CRISIL Intelligence, in its monthly roti rice rate report, said the cost of a home-cooked vegetarian thali or a full-plate meal declined about 1% year-on-year in February, while that of a non-vegetarian thali grew 6%. The decline for vegetarian thalis was also because of a fall in prices of tomatoes and LPG cylinders. Tomato prices, which of course swing wildly through the year, fell 28% year-on-year to 23 rupees a kilo in the month from 32 rupees a kilo last month, thanks to a 20% increase in arrivals. On the other hand, LPG, that's the cooking gas cylinder prices, fell about 11% to 803 rupees per 14 kilogram cylinder in Delhi from about 903 rupees a year ago. That also helped. On the other hand, what's keeping prices still high relatively is because onion prices, which are up 11%, potato prices up 16%, and vegetable oil prices up 18%. Vegetable oil prices, if you've been listening to the core report for some time, were usually low thanks to lower import duties and have actually helped in keeping overall food inflation low. Now, of course, duties have been raised. Economists Reuters spoke to said they see a continued slowdown in vegetable prices and that they were seeing a softness in pulse prices, or other pulses, as well as cereals, which are the most sticky parts of food inflation because their harvest season is not as frequent. There have, of course, been warnings from the Indian Meteorological Department that summer and heat waves could start early, and that in turn has raised concerns that inflation could rise once again as winter supplies start to run out. Meanwhile, former Agricultural Secretary to the Government of India, Siraj Hussain, wrote in Money Control yesterday that despite a warmer winter in January and February, the general assessment is that wheat, chana, and mustard production may not be much affected as the temperature has been a little cooler in March thanks to snowfall in Jammu and Kashmir. He quoted a presentation made by AgriWatch at the Future of Milling conference recently, saying that there was no adverse impact on crops due to a warmer February. In fact, their estimate of wheat production, he says, is 8.2% higher than last year, though things may turn in March as it is expected to be much warmer and affect wheat production. But one good signal of the crop size could be the market price of wheat, which in Uttar Pradesh and Delhi is in the range of 2,900 to 3,000 rupees per quintal, which is 100 kilograms. And he wrote that farmers right now may have to worry more about what happens if India is forced to reduce tariffs on agriculture products from the United States. Speaking of wheat specifically, the US is amongst the leading exporters of wheat in the world, though not very large amounts. Oil prices are steady. Oil prices are still holding steady as concerns over US import tariffs on the global economy continue to weigh apart from the now hanging sword of increased supply by the Organization of Petroleum Exporting Countries Plus producers. Brent crude was down about 11 cents at about $70.25 a barrel on Monday. Last week, says Reuters, marked WTI crude's seventh consecutive weekly loss, the longest losing streak since November 23rd, while Brent fell for a third consecutive week. Don't ask for tax cuts, says Minister. Several capital market players and investors have raised the issue of capital gains taxes on sale of shares, particularly foreign portfolio investors. While, admittedly, taxes are not a magic wand in themselves, they do help in bringing back investors, particularly when they've already left, when other factors ranging from valuations to currency to earnings are not looking as good. In an apparent response to this clamor, or maybe even others as well, Union Minister for Road Transport and Highways Nitin Gadkari on Monday urged industries to stop persistently demanding tax cuts, emphasizing the government requires funds to implement welfare schemes for the underprivileged, according to a report in Business Standard. He in turn promised that he would bring down India's logistics costs, currently at 14 to 16%, to about 9% within 2 years, making the country more competitive in global markets. For comparison, logistics costs stand at about 8% in China and 12% in the US and Europe. He also said that businesses should not repeatedly seek reductions in goods and services tax and other levies. He says this is a continuous process. If we reduce the tax, you will ask for more because this is human psychology. He stressed that while the government wants to lower taxes, it cannot function effectively without revenue, and without it, they cannot run a welfare state. Now, this is, of course, an interesting poser. Will you pay high taxes if you're able to achieve greater efficiency in operations and thus save there and see more bottom line impact? Speaking for or as a company, that is. It's tough because I suspect people want both and feel that all of that should have been coming much earlier. Thermal coal imports are up. India's imports of thermal coal, mainly used in power generation, fell for a sixth straight month in February, Reuters said, quoting ship tracking data. The reason attributed is that coal-fired power generation grew at a muted pace thanks to a slowdown in manufacturing activity, and this is the longest such streak since February 2022, when imports had declined for 8 consecutive months. Manufacturing activity in India has slowed to its weakest pace in over a year, Reuters added. A new pharmaceutical industry pathway. Even as we find our way on the treacherous path that is tariff negotiations with the United States, there are industries which are on relatively strong footing and could grow, assuming other ducks fall in line. At the recent BioAsia conference in Hyderabad, which I participated in, Boston Consulting Group released a report saying that India's Contract Research, Development and Manufacturing Organization, or CRDMO sector, is expected to expand from about $3.5 billion to date to about $22 to $25 billion by 2035. That's in about 10 years' time. The reason for this, BCG says, is because of global pharmaceutical realignments, increasing biologics demand, and India's cost efficiencies. It also highlights India's strong foundation in small molecule manufacturing, while highlighting new opportunities in biologics, antibody drug conjugates or ADCs, gene therapies, and RNA therapeutics. There are, of course, regulatory and doing business challenges, and some of them are quite significant and seemingly more acute than what many other industries in India face. I reached out to Vikash Agarwala, Managing Director and Partner at BCG's healthcare practice based out of Delhi, and I began by asking him to define CRDO for us, how it was different from generic drugs and exports of them, and talk about its larger potential.
Look, CRDMO is a very different industry versus what India is known for, i.e. generics. CRDMO stands for Contract Research, Development and Manufacturing Organization. These are companies which offer services to innovators. And when I say innovators, it is big pharma, it is the biotechs, which are working on developing and commercializing molecules which will be patent protected, right? Unlike generics industry, where most of the products are launched after the patent is expired, right? So this is kind of innovate in India versus make in India kind of a story that I'm talking about. And they primarily help in 3 aspects to all these biotechs and innovators. One is on the drug discovery side, then development, and of course, manufacturing support during the clinical phase, also during commercialization. So that's what this industry does. In short, they work as a service provider to big pharma and biotechs, and they only work on molecules which will be patent protected, right? And therefore, there's a lot more development work that's needed.
Right. So this is a roughly $3.5 billion industry, which you are saying as Boston Consulting that could become much, much bigger in the next couple of decades. Before we come to that, what illustrates or what are the best illustrations of successful contract research and development projects, if we know them?
Govind, you're talking about Indian companies?
Where Indian companies have done this kind of delivery.
So in India, there are multiple. I think a lot of these companies came together under the banner of IPSO very recently, right? So you would know Syngene, Piramal, Aragen, Newland, to name a few of them. They've been very successful. And also DVs, for example, they also have a very large innovator-based CDMO business, but currently not a part of IPSO though. So those will be the 5, I would say, good names from India amongst the top companies in this particular sector. And of course, Laurus, that's also large.
And what would be a successful project that you are familiar with? Let's say, what kind of drug or medicine would they have manufactured, clinically tested, trialed, and then sent back?
So there are many, like even during COVID, many of these molecules that we all became household names were manufactured by many of these Indian companies, and they help not only in development, but also manufacturing and serving not just India's need, but also needs for patients all across the world. Yeah.
So why do you feel that this is a large opportunity in itself as compared to, let's say, other opportunities that India can specialize or evolve in?
This is about innovation, right? India historically has been known for being the pharmacy capital of the world. And unlike US and China now, there is a lot of work happening on innovation, right? And when I say innovation, if you look at a generic product versus when it was under patent, the value difference would have been, from a price point of view, almost 20x to times even 90x also, right? So which means that if you go on the innovation side, the value per unit volume equation goes up quite substantially, right? So it is an opportunity for India to move up that value curve. The second bit is, from a capability point of view, there are a lot of capabilities which are very similar in terms of where India has very strong, I would say, capabilities around chemistry, around manufacturing, around development. You have the starting base of capabilities. And this also gives you an opportunity to move up the curve from a value per unit volume perspective. And this is how, for example, China built a lot of scale companies. Wuxi, for example, you might know the one single company which is almost 2x of the entire CRDMO sector in India, right? So opportunity is huge in my view. There are few factors which are kind of driving this opportunity in my mind. If you were to look at it, there are four key ones. First one is there are these global supply chains which are realigning. So people are looking at de-risking this entire discovery, development, manufacturing process and looking at various alternatives to China, for example. And India could be one of the natural alternatives in that context. Second one is also from a innovators point of view as well. And when I'm talking about innovators, not just big pharma, but also biotechs, they're also facing some sort of a pricing pressure, right? Given some of these acts like IRA. And that will mean that for the same amount of money, you need a larger runway to run. And India also provides cost advantage, which could be then helping some of these companies to get there. The third thing is government of India is very now keen on driving innovation out of India. And you'd have seen the BIRAC funding. There is a program called PRIP, which is just about to get into the disbursement phase very shortly. All of that is geared towards innovating in India. And that will also create some of the ecosystems which will help some of these CRDMOs to develop and grow. And lastly, but not the least, there is also a lot of, I would say, action around new modalities in the larger molecule space, where India can really leapfrog and build a lot of capabilities and provide a lot of alternatives to biotechs and big pharmas of the world. Yeah.
Would it be correct to say that for most, let's say a lot of Indian manufacturing in drugs is in the generic space, that we manufacture the powder or whatever and export it to countries like the US where it gets assembled and then sold? Is CRDMO a natural progression for this entire set or subset of companies?
So I would say the work is slightly different. The capability, it is similar, not exactly the same, right? Because in one area, you are looking at something which was already developed and trying to, in a way, kind of in very crude form, copy-paste, reverse engineer that. Whereas on CRDMO, you are actually, while the capability is the same, you need chemists, right? You need manufacturing guys, you need quality folks. But you are actually doing something which has not been done before. You are actually synthesizing something which is new chemical entity or a new biologic entity, something which is new to the world. And also it is a lot more, I would say, stringent from a process point of view, because this new drug will eventually find its way into a human being, right? So it has to be tested multiple times over, and the entire safety, efficacy, everything has to be guaranteed through the whole process. While the basic building blocks could be similar, but the industry is very, very different in my mind, at least, from the way the things get done and from the way the end customer looks at it. And this also, I would say, done well, this can provide a significant fillip to India's brand image globally as being the center for getting some of these most innovative products out there for the world.
Amongst the challenges that you pointed out, you said that the regulatory delays, which is 3 to 10 months longer than West in order for the industry to, let's say, get going faster. And you also said that there is a longer startup time because of reliance on China and West for raw materials. So how do we, what can India do to speed up here?
See, here, I would say there are a couple of things. One big intervention would be from a, I would say, policy simplification point of view. What I mean by that is, if we are to be truly competitive and in a global industry, rather than look at policies for this sector from the lens of what works in generics and then copy pasting that onto this, there should be separate policies from a CRDMO lens. A very good example could be picking up, say, what, for example, Korea is thinking right now, or China is doing, or what happens in West, and looking at our policies to kind of say what is something which are no-brainers and can be removed or eliminated or simplified. So that is one big lever. The second one, I think, which a lot of work is already starting to happen, but that needs a lot more fillip, is around this whole tier one ecosystem, suppliers to this industry. Given India's scale currently, there is not enough quality suppliers who are present in India, and therefore India has to import from China or West, depending on its small molecule or biologics. So basically creating that ecosystem in India, which could be through partnership with some of these suppliers and asking them to locate in India and make in India, and with some incentives maybe, could be very, very helpful. The third could be also, I would say, in short term, basically speeding up the clearance time at different bottlenecks during the supply chain, which should be a joint work between, I would say, industry and the various authorities. So those three things could really, I would say, debottleneck the timeline kind of an issue.
The CRDMO, I would say, so if generics is, let's say, lower down the value add chain, this is the next level. Let's say the more sort of original innovation and discoveries at the top level. And would that be a correct way to stack it?
This is the original discovery and innovation, right? So there is basically a new drug comes to this planet. And in that process, CRDMO is a service provider. So they will provide a service in terms of the research side, the discovery side, during the clinical phase, or it would be during the development and manufacturing phase. So they are actually working hands in gloves with the Pfizer's, Novartis's of the world and many biotechs which are in that particular area. Then once the drug goes off patent is when the generic industry comes in.
All right, Vikas, thank you so much for joining me.
No worries. Thank you, Govind. Thanks for having me.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.